Thank you all for making your way back in. We've got quite a few exciting speakers left, so we don't want to stand between them. And I never want to stand between you and lunch, so we'll make sure to not do that. But as we kick off, one thing at Farm Credit Illinois that we think about is how can we bring some of these internal conversations that we're having about the economy and some of these tough topics that you guys brought up in your questions. It's not always a fun place to be in farming right now, and we know that and acknowledge that. And so we thought nothing better than to bring some of our in-house expertise to you all to share just some tidbits and takeaways of things that you can be doing in this economy to, best be mindful of your farming practices and some of the not so fun bookwork and nitty gritty stuff that we don't love to do in the winter months, but is so important for our businesses. So to help us do that this morning, we have a few folks with us from different facets of Farm Credit Illinois. So on the end here, we've got Brian Coster. Brian is a vice president with our credit team. So we're happy to have, the credit lens in the room, the one that's looking at your loans when you're applying. So he is in the far seat. And then in the middle here, we've got Birgette Volk. Birgette is our VP of Related Services. So what she oversees is our crop insurance team and our Rural First team, which is our rural home lending. So she's got that expertise behind her. And then here on the end, we've got Senior Vice President of Marketplace Delivery. So Sean Gress here oversees our field teams and just a lot that goes on out in our regional offices and in the marketplace. So without further ado, I will let them take it away.
Perfect. Thank you, Caitlin. Well, folks, I think after listening to Susan's presentation, right, we all know that this next year is going to be an interesting one for all of us. And when we're headed into a year of this kind of uncertainty, really understanding and knowing where to invest your time and your energy and your capital can make a difference between simply surviving the next year in this downturn or thriving through it. Markets are shifting, right? Cost of production is shifting. Your opportunities are shifting. And so your strategy has to shift along with it. So what we want to do today is really just talk you through from our perspective, right? Through the credit lens, the lending lens, the risk management lens, talk to you about some strategies for 2026 and how you might thrive through this time whenever you're thinking about doing 6 things: optimizing your opportunities, optimizing your assets, your liquidity, your operation, your risk management, and your network of experts. We're going to talk a lot about that today. You're going to see why that's so important. I'm going to kick us off and really talk about optimizing your opportunities. We're going to kind of talk to you about where to lean in and where maybe you need to think about leaning out as we go into 2026 crop year, okay? So when we started preparing for this presentation, our chief credit officer who relinquished his duties and sent Brian in his stead today, reminded us of a quote from Warren Buffett that it really stuck with me. He said, "Be fearful when others are greedy, and be greedy when others are fearful." Now, obviously, he was talking about Wall Street, right? But I think this really applies to where we are at in agriculture today. A lot of producers, right? When times get tough, we have a tendency to kind of want to hunker down, maybe even retract and pull back. But history, if it's shown us anything, tells us that there are great opportunities, great strategic moves that can be made during these difficult times when everyone else is running away. Okay? Here's the key though. Sometimes the strategic opportunity is in hunkering down. Sometimes it is in contracting. It's not always about going out and taking advantage of every opportunity that comes your way. In 2026, if you take anything away today, I would tell you that the key is finding strategic clarity for your operation. Your operation, not what's happening around you, but for your operation. So where are we going to lean in when we're talking about opportunities and optimizing your opportunities? Well, first of all, right now is creating a lot of windows for opportunity, and they're not going to be open forever, right? cash rents are being renegotiated. You have equipment markets that are softening. You have land that's going up for sale. Opportunities are coming forward every single day. But the flip side of that is not every opportunity has to be yours, right? You have to think about what your next strategic move is. We're hearing a lot of stories in the news right now. I was watching Tyne Morgan, a US Farm Report, and she is sharing about a producer who, took 3,000 acres off his operation, right? And felt like he now had a more profitable operation. It was a really powerful story she did, but it was a powerful story for him. And I think that's the thing for everyone to remember. Contracting or even doing the same thing, that can be really valuable. That can be a very good decision, a very good strategic decision for you. But the key is it has to be your story, right? What we have to lean out of is not stress testing the numbers, right? Just saying, well, it makes sense. If I contract, if I kind of pull back, it has to be better for me, right? Brian's probably going to tell us the numbers don't always bear that out, but maybe it is getting rid of your lowest, acres that are least profitable on your operation. But I think for you, finding that strategic clarity is going to be the key. Okay. Lean out though of not stress testing all of those numbers and saying, what does it mean to me? What does it mean to my operation if I stay the same, if I contract, or if I move forward and take advantage of all of these opportunities? The next place we want you to kind of lean in is disciplined diversification that actually hedges your risk. And notice I didn't just say diversification. I said disciplined diversification. There is a difference. There's a good kind of diversification, and there's a diversification that's just for the sake of diversification and thinking that, I'm hoping that's going to be better for my operation, and hope is not always a strategy that's best, right? We hear that all the time, cliche for a reason. Good diversification can be a lot of things. It can be adding a specialty crop or a new practice on your farm that has a strong market demand and strong margins, right? It can be, maybe it is livestock for you that's leveraging your existing infrastructure, and that is the key. It leverages what you already have, right? It can be adding an enterprise like custom farming to diversify your income streams. Right, we were just chatting before this, and one of our fellow farm credit employees was talking about converting row crop acres to pasture because he had a lot of what he needed on farm anyway. And though it cost him to make that conversion, it was still better for him. Now he did hedge and say, "Tell me what the cattle market's going to do long term, and I'll tell you how smart I am." But we don't know. We don't know what's going to happen with corn, with soybeans, with the cattle market. There's a ton of uncertainty, but he did his best, penciling it all out and saying, is this diversification the best for me and my operation? And ultimately the decision was yes. So don't just chase trends because everybody else is doing it, right? Really decide, is this hedging against risks that I have on my farm? Am I leveraging the assets that I already have? How is this going to work for me? Don't do diversification for diversification's sake. And finally, you're going to hear this at probably every winter meeting you go to. I don't think anyone is not going to talk to you about taking advantage of forward contracting opportunities. And I really love how Susan answered that question. Tell me how much of your old crop you have left, right? But I loved her conversation about don't let what's still sitting in the bin and maybe decisions that you've made in the past. You're like, man, I probably should have pulled the trigger in those areas. Don't let that stop you from doing what's right going forward. Okay. So you don't have to be a genius trader to make this work. You can find a network of experts who are going to plug into you and help you make those decisions, sort of force your hand in that regard, right? Because the key is really setting your targets, knowing your floors, setting those targets, and acting on them before emotion takes hold, right? Because that's what ends up preventing us from really pulling the trigger and doing the things we want. The most expensive mistake that you can make when it comes to marketing is having no plan at all. And the second after that is chasing the perfect price and missing the profitable one. If it's profitable, you don't have to sell it all, sell some. You didn't lose the 15 cents, like Susan said. You actually got another 10, right? So be smart, be strategic, and lean into your network of experts when you're thinking about diversifying, when you're thinking about taking on opportunities, when you're thinking about forward marketing. And with that, I'm going to turn it over to Sean, who's going to talk to us a little bit about optimizing, or sorry, Brian, for optimizing our assets.
Morning, everybody. I have this terrible habit of moving the mic away from my mouth as I talk. So if I do that, please just throw something at me, raise a hand, whatever you got to do. Just get my attention so that, you can hear what I've got to say. But um, we're going to talk about optimizing assets. And so optimizing assets is really that bottom 2/3 of your balance sheet, right? So the top third, you've got your liquidity, which is so important that Sean's going to hit on it in a separate slide here in a little bit. But when we say optimize those assets, we're looking at those down balance sheet items, primarily going to be your machinery and equipment and your farm real estate. Those are going to be the two biggest term assets on most farm balance sheets. And so when we're talking about lean in strategies, one of those lean in strategies is going to be looking at those underused assets. Really be taking a critical eye to what you've already got on your farm and whether or not it's serving the purpose that you need it to serve, or could that capital be redeployed somewhere else in your operation that's going to generate you more profit in the future. And so that's to say, if you've got a piece of equipment, even if it's paid off and it's in your shed, that's still capital that you have on your farm that's sitting in that shed that could be used elsewhere if that other use generates you more income in your operation. So really taking a critical eye to some of those things that you've already got and asking the question, does this serve me in the purpose that I need it to serve me? And then as you look at the other assets that you already have on your farm, are they generating you income? Or do you have stuff that's just kind of sitting around? So, I think a lot of guys, we have our grain inventory, the bins are full, it's down at the elevator. Maybe we've sold some, but we're sitting on a pile of cash. You've heard your lender preach over the years, well, you need liquidity, you need liquidity, you need liquidity. So we need that working capital number, right? The lender wants to see that on my balance sheet. But the question is that liquidity generating you anything, or is it just sitting there, right? So you can have cash, or you can maybe take some of that cash, put it in a short-term CD. Now the rates have come down some, but that's still generating you more than it's generating you in a savings account or a checking account. Like, there's opportunity out there. Maybe you can have a brokerage account where you can put it in and just put it in an index fund that's going to generate you some level of return. It's still liquid. If you need to tap into that resource, you can tap into that resource. But in the meantime, it's making you money. So looking at where you're investing those assets to generate you the most amount of profit. And even looking at some of those wants versus needs, right? I mean, you can calculate a payback on a grain bin. How much am I paying each year at the elevator, putting this into open storage or putting in this into DP? Does it make sense for me to build some storage on my farm? Is that an investment that I can make in my operation that's ultimately going to generate me more revenue? And then you can also look at, how do your assets fit into your operation? Are you equipped for the acres you have? Right? I'm operating, you're operating 2,000 acres, maybe picking up 1,000 acres becomes an option. But if you start looking at that increase in unit size, do you have the equipment to do that? So it kind of comes back to what Birgette was saying about optimizing your opportunities, right? But have discretion in the opportunities that you're looking at. Do I have the capital that I can deploy with the growth opportunity that exists, so that I'm making sure that I'm being appropriately equipped for what I'm trying to do? When you're looking at your lean outs, this one's going to be a little controversial, I think, but borrowing money to buy equipment to offset a tax burden, right? I'm not saying that we should just pay all the taxes that are out there, but what I'm saying is be mindful of borrowing money to do that, right? Because if you buy an asset and you depreciate it all in the given year that you buy it, and then you take out a 5-7 year loan on that item, you're not getting that tax benefit of that depreciation in those out years. You took it all in 1 year, but you're still making payments on that piece of equipment for the next 5 to 7 years. So you've got an expense that's going to run out, that's going to go out longer term, that's not going to be generating you anything. And you can get in this cycle where you have to keep doing that and you have to keep rolling. And with interest rates where they're at, urge you to be cautious when you're making that decision. If you need a piece of equipment, by all means, buy a piece of equipment and work with your accountant to figure out how you can maximize the tax benefit on that as best you can. But just be cautious of borrowing to do so. And then the last thing I want to touch on this slide is watching that mismatch assets and liabilities, right? So a lot of people have an operating line. That operating line is supposed to be used to fund 1-year crop expenses for your operation. What happens is sometimes you'll have an opportunity to buy something and you maybe need to move a little quick, and so you'll buy it on that operating line. You know, maybe it's, oh, I got a great deal on this tractor, but I had to buy it today, right? So you put it on that operating line. Well, now you don't have that capital for your operation. You don't have it to go buy inputs, to go buy fuel, to go buy whatever, to go pay cash rent in the given crop year that you've got, right? So, well, now I need to term it out. Well, depending on what the capacity of your operation looks like, you may not have that opportunity. And this is where we see a lot of operations get out of balance. They buy long-term assets with short-term money. And so then they get into that liquidity problem, which again, Sean's going to touch on in a little bit, but it also goes the other way. So, you know, I touched on the machinery purchases a little bit, but if you're buying equipment, you're financing equipment, that number starts to get big. Those payments are high, right? Because shorter terms, 5-7-year terms, right? So you can say, well, I've got equity in my real estate. Maybe I can tap into my real estate equity and I can take this loan and I can stretch it out over 25 or 30 years. That's an option, but you got to remember that asset that you financed under those loans isn't going to be there in 30 years. That tractor, that combine, whatever piece you bought on that 5 to 7-year term is going to be gone. It's going to have to be replaced, and you're still going to have that loan. So even though that payment is lower and maybe that works better for your operation, you're going to have to buy another one, or you're going to have to finance that one too. So now are you paying on 2 loans for one combine that doesn't exist and one combine that does, and you're just stretching it out and you tapped into that equity? It's an option, but I just be cautious when you're looking at those types of things. And so now Sean's going to touch on that top third of the balance sheet by talking about optimizing your liquidity.
Yeah, thanks, Brian. Sounds like you speak from a little bit of experience, right? You may have underwritten a loan or two, or you got a credit package where the story says, hey, this balance sheet doesn't look on face value what it is. Let me tell you the story. In that operating line of credit, there sits a tractor. In that operating line of credit sits a skid steer. In that operating line of credit sits a big downstroke on a farm purchase. And again, if every one of you today could tell me exactly what that future looks like, I could tell you with some level of certainty that we can, that makes sense to leave it there, or it doesn't. The reality is we don't live in that world, right? And so, like many of you, I grew up in agriculture, and I've spent the last 23 years in direct lending in agriculture and agriculture exclusively. And if somebody pushed me in a corner and said, I need the top 3 things that you would say over those years, which had plenty of cycles, just like we're in now, what are those top 3 things that a farming operation had to navigate those cycles? I would answer them this way: working capital, working capital, working capital. Folks, I won't go through every one of these. I know I threw a lot on this slide relative to some other slides, but I can tell you time and time again, when we look at operations, work with operations of all sizes, of all disciplines, of all diversities, if you will, at least in the Midwest agriculture space, the folks that respect and protect their working capital generally come out of times like we're in now less stressed and with more optionality. In times when volatility increases, you want to have optionality increase for you. And when you think about that top third of the balance sheet, you say, Sean, great, that makes a lot of sense, but you got to have profitability, or where does that working capital come from? And the answer in that first bullet point is the best place is from earnings. And that certainly is the case. And I'm not here naive enough this morning to realize the last 2 years, maybe that wasn't possible. But the reality of the matter is as we cycle, and we will cycle again, when you have that opportunity and you have that margin on your farm, you're going to service debt, you're going to pay your expenses, you're going to service debt, you're going to build equity, respect and protect that top third of that balance sheet and that liquidity. You may go, well, that's fine. That's a great concept, but give me some more tangibleness to it. I threw 3 measures out there to monitor that we look at. Working capital to VFP. VFP meaning value of farm production. Most of you might call that your gross revenue, your gross income. And so let me give you a quick example. If I've got a balance sheet in front of me from a 500-acre farmer and it's got $250,000 of positive working capital on it. And I look at the next one and it's a 5,000-acre operation and it's got $250,000 of positive working capital on it. Working capital defined by total asset, or excuse me, current assets less current liabilities. Which one's in better shape? They both have the same nominal number of working capital. Which one's in better shape? The smaller one, right? They have more optionality to manage through opportunities, to manage through stress, because relative to their operation, that dollar, that nominal number stretches a lot farther. And so what we look at is when you measure, okay, where my working capital is, do the nominal number, but then gauge it against your gross revenue. A minimum standard, an underwriting standard of ours. Quite frankly, if you don't hit this standard, it's an exception to our underwriting guidelines. Is 15%, 15%. Minimum. Folks, it was several years ago that on a stage similar to this, Dr. Cole stood up and said, hey, with this increased volatility, with this increased dynamics in the ag space, you should double that. And I will tell you, I think he was spot on. And so if I was advising anybody today that had the ability to do it, and you'll have times where it's like, I can't get there because of something that happened on the farm or something happened in the broader economy or both, I would encourage you, 30% may be the new norm. I think we'll leave our underwriting standard alone. We don't like to write a lot of loans that have a bunch of exceptions on them, but nonetheless, 30% would be my takeaway, or at least my something to impress upon you today for a takeaway. Another way to look at that is working capital per acre. I got a couple lenders in mind. They do a great job of counseling row crop producers, and they'll say, hey, can you look at that crop? Can you own a third of the crop along the life cycle of the crop? Said differently, right? Can you have $300 an acre of working capital? Think about a $900 crop. Can you have $300 of working capital? So that's another way to look at it if you're more of a hard dollar number versus the ratio. And then the other thing I'd look at is monitor that operating line utilization. We spend a lot of time talking about right sizing lines of credit. Folks, we don't have a silver bullet on how to right size a line of credit. If we did, the silver bullet, we'd be predicting what's going to happen throughout the growing season, what's going to happen throughout the crop marketing season. What we do is we have some guidelines that we look at to set a line of credit up based on standardization of corn budgets, soybean budgets, and it tends to work really well. What we'd have less control over that is, okay, then how does the borrower in this case leverage or behave with that line of credit? What does your utilization look like? To Brian's point, if it was mismatched assets on the thing, you may be a utilization issue or a line of credit issue because of that strategy. So we need to sit down and talk about, hey, does it make sense to take that skid steer, to take that tractor, to take part of that land purchase and move it down the balance sheet to free up your working capital, to give you that wiggle room? Sometimes it's a matter of the timing of your marketing plan. Any lender that tells you they know how best to give you advice on a marketing plan, run. I'm here to tell you, right? This is our bread and butter of loaning money. And I'm here to tell you, if any one of our loan officers tell you, I know exactly how to market your crop, run. What I would love that conversation to look like is something like this. Hey, I've got a marketing plan I'm putting together. I'm trying to fully bake. What do you see, lender, in my balance sheet that gives me some risk? What's my risk appetite or my risk ability if I execute that strategy? And you may hear something like this. Well, with that type of working capital, you got a lot of margin for error. You can do a lot of different things. Or you may hear something like this. Hey, I'm not a marketing advisor. The reality of the matter is, with your working capital position right now, you got to be really sensitive because you don't have a lot of dry powder. Then the best thing they can tell you is go talk to your marketing advisor, go talk to your marketing expert, and make sure you include your risk management plan as well. So talk to your crop agent. What underlying protection do you have as you make those sales? Because if they tell you they know the answer, I'll say it a third time on purpose, run. So I put these all on here. And again, this lean out strategy, lean in, lean out strategy, talked a lot about protecting that. I also want to spend just a brief minute talking about one of those on there that talks about working capital gives you leverage when adversity. We talked about that. But when opportunities show up, folks, I will tell you that to Brian's point, there's time that makes a lot of sense to buy that tractor and write the check and move on. But you know what? That farmer, a big downstroke on a farm, instead of advancing or borrowing 70, 80% on a farm, it may make sense to finance 40, 50% because it'll cash flow a lot better. It just depends on the situation. And so if you look at the lean out, the dry powder analogy, that's my best analogy that I use as I've taught financial courses for years, is you don't want to go into any battle, whether you're scraping by, battling adversity, or you're trying to seize that next opportunity because you got some wiggle, without dry powder. Keep your powder dry, and it makes sense. The best operations that I've seen, let me say that differently. They're surviving operations with less stress that I've seen over my 20 some years are the ones that don't always keep the pedal on the gas, nor though do they keep their foot off the gas. Keep their foot on the pedal, I should say, their foot on the pedal. They feather it depending on their situation in front of them, depending on their working capital position. And so if I could wrap this section up, is those strong farms, or those any strong farms, if you look at that last bullet, when I first start to see some falter, the first thing I want to do is look at the top part of the balance sheet. And then I'll ask questions. Tell me why the working capital year over year, or tell me why this, because usually there's a story behind it. And sometimes that story is there was no margin. I lost money. Oftentimes that's part of the story, but not all the story. And so that's what I want to press upon today, is really respect that top part of that balance sheet.
Yeah. And, to Sean's point, that liquidity gives you opportunities, right? Because it lets you make the decisions you want to make rather than the decisions that you have to make. So this next slide we have titled Optimize Your Operation. And I struggle with this a little bit because in my mind, it's really optimize your profitability, not necessarily just optimizing your operation. The first one on there on lean in is pretty self-explanatory. It's manage your costs, know what your costs are, manage your costs. I think Susan said it earlier, the payback on corn, if you look at the farm doc, is negative, right? So how do you make that pencil? Well, you can look at the costs because that's the part of the operation that you have some control over. When you're looking at that, you can also, knowing your break evens, it goes along with knowing and managing your costs, but know what you can sell grain at, corn at, beans at, wheat at a profitable level. So again, as Susan mentioned it earlier, selling beans 10 cents higher than you sold them yesterday, but you missed out on 15 cents more tomorrow. Did you make money on that? Did you make money on that sale? I actually came up in the grain merchandising industry too, and we used to always say that it's better to hit a single every year than it is to hit a home run once in a while. And knowing that break even level and having your risk management plan in place helps you hit a single every year, because that's how we can keep the operation growing and keep moving in the right direction. One other way to looking at optimizing that profit is looking at additional sources of income. So you've heard a couple times today where it's been thrown out, diversification. I think Burgett touched on it earlier. And what does that diversification mean? I mean, not everybody has the ability to go put a herd of cattle out or do something unique like that. It can be looking at how your operation is set up and what opportunities do I have with the current configuration of my operation. Maybe you have a combine and there's an opportunity to pick up a couple hundred acres of custom for a neighbor. Maybe it is an opportunity to take on some specialty crops. I've been talking to a few growers down south that are doing winter canola this year. So it's the first time I'd heard winter canola in Illinois. But they saw it as an opportunity because they always grew wheat, and the payback on the canola is a lot better than the payback on wheat. And so they're taking an opportunity to give it a shot because they're set up to do it. So those are the opportunities that you can look for. They didn't have to make any adjustments to their operation to do that. They just got some acres under contract for canola and they were willing to try something different. So I think that's kind of the message there, is look for those opportunities to generate that additional revenue without really increasing your overall costs. On the lean out side, we have to be conscious of managing to that top line revenue number, right? So we all want to grow the most corn. We all want to grow the most beans. We want to have the biggest yields. We want to make the most amount of top line revenue, but that doesn't mean that you're making the most profit. And profit's what's going to keep the lights on and what's going to go in your pocket at the end of the day for your operation. There are times when growing 240 bushel corn makes you more money than growing 280 bushel corn, depending on what you have to put into it to grow 280 bushel corn. And so managing that cost structure of your operation, knowing your break evens, and it all kind of coming together into generating the most profit for your operation is the most important part of managing that optimization of your cash flows. This kind of goes along with it. We touched on this again this morning. Watch out for unprofitable cash rents. I know it's hard because when you see $450 an acre, $500 an acre out there, somebody's going to take it. Somebody probably will take it. But look at how it fits into your operation and look at how it affects that cost of production for your farm. Because if you can spread out $500 an acre across your entire unit size and make it cash flow, then I'm not telling you not to do that, but you can't make that decision in a vacuum, right? We have to know what the payback on that acreage is, because paying $500 an acre in cash rent and losing money on every acre you run across on it isn't going to help your operation, right? And then the last point up here is not valuing your expertise. And I think to that, it's really look at where you fit into your operation. Where do you add the most value to your farm? What is the skill set that you have as a producer, right? Is your value best applied to turning wrenches? Is it best applied to running the semi, hauling grain? Or is your value best applied to being in the office and managing the books? Is it coming up with that marketing plan? Is it networking with your experts? Do you have an opportunity to outsource some of those things that maybe don't require your expertise? Maybe you enjoy doing it. Maybe you're good at it. But if you have a skill set in marketing grain, then you should focus on your marketing grain and get other experts to help you in those other areas. So know the value that you provide to your operation and where you can add that value the most.
Well, let's chat a little bit about optimizing your risk management. This is quite a year in our world for crop insurance and really just the national farm safety net in general. You know, we've been talking about opportunities and assets and liquidity in your operation. And folks, risk management is what ties all of those together. And it's not just about crop insurance. I mean, that is a critical piece of the puzzle. But building layers of protection with all the tools that are available to you is the name of the game today. So what I want to talk to you about first is leaning into a comprehensive coverage analysis. Okay, how long has it been since you really sat down and dug into your policy to say, man, based on my actual cost of production, what coverage do I have? And folks, don't talk to me just about a percentage of coverage. Talk to me about the percentage of coverage that you choose and what that equals in a dollar amount of guarantee. How many dollars are you guaranteed versus how much is it costing you to put that crop in the ground, right? You need to know those numbers because sometimes, hey, let it ride at 70, 75% is not the answer. Letting it ride, and this is the lean out, right? And saying same as last year approach. Letting it ride assumes that everything stayed the same. Nothing has changed in your operation. The market is exactly the same as it was before. All things are the same, so I'm going to choose the same coverage going into 2026. Folks, that's not it. And this is not a 15-minute conversation with your crop insurance agent in March. Folks, this is a 2-hour conversation with your crop insurance agent right now because so much has changed. And I'm going to talk to you a little bit about that in a minute. So much has changed. You have a lot of really impactful decisions to make this year. And I have a room full of crop insurance agents and they're going to get mad at me, but I'm going to have them stand up for a second. You just do it. It's fine. Yes, stand up. These folks right here, everything I'm going to talk about in this coming segment in understanding the One Big Beautiful Bill and the changes that are made, these folks know it inside and out. And so if you don't have somebody to sit down with you and talk you through the changes, the substantial changes that are coming your way, these folks would be glad to help you out. They're the best in the business, in my opinion. So let's talk through some of that. Susan referenced it a little bit. The One Big Beautiful Bill Act, folks. This was the biggest change to the National Farm Safety Net we've seen in, I don't even know how long. A lot of changes are coming your way, and it's not just with crop insurance. So Title I programs, so your ARC and your PLC, substantial changes to those programs this year. I know for the last few years, you're probably thinking, it doesn't matter what I pick, it's not going to pay anyway. So you just, you pick one and you move on, and you don't really even think about it. You should be thinking about it now. So I'm going to give you a few little details here. First and foremost, for folks, for 2025, it doesn't matter what you chose. That's going to pay out in October of 2026 for 2025. If you chose ARC, if you chose PLC, you're getting the best of the two. So it doesn't matter what you pick. That's only for 2025, but you're going to get the best of those. Okay. And then going forward, the changes are big. They increased reference prices, and those reference prices really needed adjusting because that's what was making that program ineffective throughout our territory. So those reference prices have increased. The payment limits have increased. You're going to have an opportunity to add to your base acres. Remember, those Title I programs are paid on your base acres, not what you actually plant. So there's going to be an opportunity to add some base acres. And for the first time in a lot of years, these programs are really going to be impactful to you. And that's the foundation of everything. If everything goes to heck, that program is going to be there for you, and it's free of charge, right? That's just something that you have. The other big change that the government made in the One Big Beautiful Bill was to shallow loss programs, right? So you have your underlying base policy for multi-peril crop insurance, but they've created these programs like ECO, Enhanced Coverage Option, SCO, Supplemental Coverage Option, which are county-based products that really cover you anywhere from 95% on down to your base level of coverage. If you took a 50% policy, it's going from 95 all the way down to your 50% policy on a county basis. These used to be kind of expensive. Folks, don't assume that previous year's performance is how these are going to work today. They have increased subsidy from 65% to 80%. And I'll tell you what, at 65%, that was a great opportunity for our producers. And a lot of them are going to see some great benefit for those. They're going to pay out this June for 2025, and we're going to see some big payments throughout our territory. But for 2026, folks, 80% subsidy on those products, that's huge. That's a wonderful opportunity to bridge the gap. And in the place where honestly you see most of your losses, it's in that shallow loss space, right? They also added some additional flexibility. So with SEO, you used to only be able to take that with PLC. Well, now it doesn't matter. You can take it with ARC or PLC. So that is a stacking option for you for regardless of what you choose for your Title I programs. ARC and PLC, in my opinion, are kind of the foundation and the start of your risk management plan. Okay, you need to be thinking about that like you're thinking about building a house, right? It's the ground you're building everything on. And then your foundation is going to come in as your underlying MPCI policy. And that is you. That's not county-based. That's your coverage. That is the most important decision that you're going to make this year. And then on top of that, we're going to add some ECO or SEO. There's the walls of our house. And then we need a covering, and crop hail can cover some spaces that, quite frankly, the federal crop insurance program cannot. And it depends on what works for your farm. I will tell you, if your question to your agent is, what's everybody doing? And I was an agent at one point, and I had a lot of folks ask me, what's everybody else doing? If you have an agent, I loved how Sean said, if you have an agent who gives you an answer to that, run. Because it's not about what other neighbors are doing. It's about what you need to do for your operation. And this is a huge opportunity for this year. So if you don't have a Farm Credit Illinois agent, I just introduced you to several of them. Make sure you catch them, because this year, that's if you can take away one thing, it's spend a lot of time with your crop insurance agent. I know crop insurance is not terribly exciting, but this year I think some of the returns that we could see are really exciting for our producers. And do look at it as that layered protection strategy. This is no longer just what do I want to take on my multi-peril crop insurance? How do I want to layer protection on top of that and make sure that my entire operation is covered and I'm covering risks that matter to me? You need that network of experts. And so I'm going to turn it over to Sean, who's going to talk about just that. Why is that so important?
Yeah, thanks, Brigitte. I don't know about you guys, but ARC, PLC, RP, YP, HPE, SCO, ECO, FBA. I literally 60, 90 days ago raised my hand and said, Brigitte, can your team build me a cheat sheet? Humble yourselves, folks. There's a lot going on in this space. And I know I got overwhelmed, right? And you feel that way. That's the punchline of this slide, this segment, as I land this plane. I'm excited to hear Eric talk about the weather forecast. But at the end of the day, optimizing your network of experts, leaning into them. This whole lean in, lean out thing started with that comment. I said, if there's ever a year, there's ever a cycle where you're going to have to truly lean into your experts, this is it. This is it. Your input suppliers, your agronomist, crop agent, marketing advisor, your lender, your CPA, whoever those are, your attorney, lean in. We work for you, folks. You should hold us accountable. You should hold every one of those folks accountable to bring value to your table. And sometimes that looks like this. Great question. I'm not exactly sure. I've got to network myself as an expert. I will come back to your table with an answer that will help inform your decision. So it's not about that the people sitting at your table always have to have the exact answer. They have to have the background, they have to have their own network, and they have to have the grit to roll up their sleeves alongside you as you lean into the cycle. And so let me land this thing from a timing perspective without reading through the slides. You guys can read what's on that slide. I want to share two real quick stories. First story, I was a young loan officer in Northern Illinois, doing what I was told to do, doing what I was excited to do, knocking on doors, stopping on farms, saying, I'd love to do business with you. Let me tell you what we can offer you. And I was really hot on the trail of this farming operation. And one day I thought it was coming together, and he stopped me as I was saying, hey, we got to do business. And he says, do you know what you're asking? Of course I know what I'm asking. This is my job, right? Do business with me, right? Borrow money from Farm Credit. He goes, I don't think you're catching what I'm saying. He says, if I choose to borrow money from you, I expect that you're going to be on my advisory team. I'm like, oh, I mean, I was young. I had hair at the time, Andy, no doubt. I was a young loan officer. And I'm like, holy smokes. He says, I'm serious. He says, I think there's a way for us to do business. But if we do business, just like the other people around my table, you're expected to come to this table and bring value to what's going on in interest rate markets, to what you're seeing in the economic landscape. And to the degree you do that, we'll get along just fine. To the degree that you can't do that, let's just say it now. I will never forget that, folks. I will tell you, I will never underappreciate that. What a great strategy to allow people to come along you in your kitchen, in your farm office, in your business, to hold them accountable and say, you know what, I expect you to bring value. Therefore, I'll exchange value back to you and paying you for your product, for your services. That's story one. Story two, then we'll land. And another producer, he was actually a member at the time I inherited him. And one day he raised his hand. I was talking about something. He raised his hand. And he said, I said, what are you doing? And he said, any decision that I make of materiality, he says, I open my hand and I think, who are 5 people that I can lean into? He didn't use the word lean into, that I can call, that I can contact to help me with this decision. And he said, what's really powerful, he says, and he was kind of a alpha dog. He says, and he closed a fist. He says, you know how strong that is? And so I leave you with today, as you think about your network, you think about navigating the landscape you're in. Who knows what 26 will pan out to be? Who knows what 27 will look like? Who knows what this government's going to do? Maybe drive home today, look at those fingers and say, who are those 5? Maybe it's both hands. Maybe it is 10. I don't know. And if there's a weak digit on that hand, think about that. How can you evolve that? How can you grow that? How can you, in this case, potentially have to replace it? But you don't have to go this along. Have you build a network, feed the network, and hold the network accountable. So with that, we appreciate your time and certainly look forward to Eric, and to the extent that we get the opportunity to serve you, whether it's on the lending or crop sides, we sincerely thank you for that opportunity. We do not take it for granted. So